What's going on, everyone? My name is Andrew and welcome to Real Estate Basics. This is episode 7, part 2, and today we'll be talking about net worth return on investment. Along the way, I'll provide some example calculations and we'll wrap it up with the upcoming topic. So continuing the discussion on what metrics you need to consider for a rental to evaluate if it's going to be a good deal or not. We've already covered the percentage thumb rules, we've covered cash flow and cash on cash return. Today we're getting into net worth return on investment, and there are still many other metrics which we have yet to cover. So the first time I heard about net worth return on investment was when I read a book by Craig Kielop, The House Hacking Strategy. It is a great book. If you haven't read it, I suggest you pick it up today or as soon as possible. It is a strategy that is incredibly powerful, and it's very easy to get into, especially as a beginner or a rookie real estate investor. So what is it? Net worth return on investment represents the total return on your investment by taking into account property appreciation, principal paydown, in addition to cash flow. Right? Cash on cash ROI only took into consideration your cash flow. It did not take into account appreciation and principal paydown. Right, but just realize net worth return on investment, this is not realized completely unless you go to sell your home or you find some other way to access the equity in your home. And using this in addition to the other metrics which we have gone over and will continue to go over, is just another tool for you in your toolbox to assess if a property is going to be a good or bad deal. So here's the equation for net worth return on investment. It's a percentage, so you multiply the whole thing by 100%, and you basically add your cash flow over an annual term, you add your appreciation of your property, and you add the total principal paydown over that year, and you divide all of that by the sum of your down payment, your closing costs, and your initial rehab, if there was any. Now realize, if you analyze net worth return on investment for a period of greater than 1 year, your numerator is going to go up while your denominator will remain the same. So you can see over time your net worth return on investment is only going to go up. As an example, we're looking at a single family home and the purchase price was $150,000. We went with a conventional loan requiring 20% down, and we were able to get a 30-year fixed rate loan at 3%. Now don't forget about your reserves. We're able to rent out this property for $1,400 per month, leaving us with a true cash flow of $249 per month. Now looking at the annualized cash flow, the annualized principal paydown, which as a note, yes, this is your very first principal payment, and over time the principal amount of your mortgage payment will go up. For ease of calculation, we will assume that your principal portion of your mortgage payment remains the same. And looking at appreciation, we're assuming a modest 3% annual appreciation. You can see after the first year, that means we've earned about $4,500 for the value of our home. Now adding all of that up and dividing by the sum of our down payment, closing costs, and initial rehab, you can see after 1 year we have a net worth return on investment of almost 22%. After 2 years, your net worth return on investment continues going up. You have more cash flow, by now you've had more principal paydown, and your annual appreciation, when you sum up the appreciation between year 1 and year 2, is just over $9,000, and that leaves you with a return on investment of 53%. Now what happens after just 5 years? Well, you have 5 years worth of cash flow, 5 years of principal paydown, and when you add up the appreciation at 3% each year, you can see your net worth return on investment is over 100%, which means you've at least doubled your initial investment in this deal. Now remember, that money is not realized unless you go to sell your home or find a way to access the equity in the home. Regardless, you can see just how powerful real estate investing can be. Coming up in next episode, we're going to continue our discussion on what metrics to consider for a rental by covering how much of a down payment you need to make and how much should you have in your initial reserves when you go to purchase that next deal. So in closing, there are a lot of different aspects to be mindful of when evaluating property. And doesn't real estate just get you fired up? I know it does for me. There are just so many different advantages to owning real estate, and I just can't get enough of it. That's all for this one. So if you like this content, please like and subscribe. And until next time, take care.